Hi YouTube, Gordon Miller here from G3. Okay, so the next topic on Quora that I wanted to talk about was a couple of different questions. So I got two questions. One is, what do investors look for in a business? And is it better to get investment or grow my company organically through revenue? And like bootstrapping. So my answer is always yes. The answer is whichever is the most appropriate. But my answer is grow the business to preserve the most equity and to retain the most value for the company. Now, in my case, my first company, actually all of the companies so far, have grown organically through revenue. And my answer is it's always better to have revenue than it is to have investment. If I could increase your business by $1 million with a 20% margin and have you put $200,000 in your pocket, would that be better than finding an investor that gave you $200,000? Well, the answer is yes. I mean, you don't have any equity split, you don't have any profit split, you don't have any other future problems. So my approach is always to find ways to cut costs, increase revenue, and focus on generating profit. And because that profit is much more valuable, for every dollar of profit, it's worth almost $10 in investment. And so you want to make sure you focus on building your business organically if you can. I'm a huge believer in that. I think that's really important. The other thing is that what do investors look for in a business? So if you're going to look for investment, the one thing you have to understand is that if you are an app-based solution, you're going to need subscribers. You need at least 10,000 subscribers, even if they didn't pay. If you got 10,000 people to not just download your app, but sign up in some fact, like register for something, then you've got something that investors are going to pay attention to. If you have 100,000, that's even better. And if you have 10,000 paid members, even as little as $1, then if you got 10,000 people to give you $1, then investors can typically see some value in that. Now, most investors are looking at, somebody said, well, what about if I'm pre-revenue? Well, every business is pre-revenue at some point, but there's a difference between not getting to a point where you're able to generate revenue yet and launching something and not generating any revenue. So the thing that I look at is some deals people have been actively deployed for several months and they have $0 in sales. Well, whether that's due to poor marketing or whether that's due to not understanding the market, it's hard to say. But right now, the focus for most investors is show me $100,000 in revenue, at least. Show me something. And the thing that people have to understand is that most companies are worth about 1 times revenue, or about 5 to 7 times EBITDA, which just loosely translated is if you take the amount of profit that you're making in a given year and multiply that by 5 or 7 times, that's about the amount of money you can expect the business to be worth. So if you have $100,000 in revenue and you put $20,000 in your pocket, 5 times 20,000 is $100,000, which ironically is exactly how much you had in annual revenue. So you can't go necessarily seeking $100,000 worth of investor money because the business is only worth $100,000. So you have to get the business to a point where you've grown it enough to where it looks like it's an investable business. Now, don't get us wrong. Now, I see this happen so many times about the fact that, it's going to be worth that in the future. Well, investors don't want to pay on future value. Their money is what's going to help you get to future value. What you have to understand is you have to price it at what the value is right now. And so getting that revenue up to a point where it makes sense to take investment is what the goal is. Now, understand, just because it's not an investable business doesn't mean it's not a great business. I mean, if you're making $100,000 a year and you have a 50% profit margin, then you're making $50,000. Well, that's great. I mean, that beats working somewhere for $50,000 a year. And you're on your way and you're building that business. But don't think that you're going to come to an investor and look for them to put in $100,000 and then all of a sudden walk away with somebody else's money that's going to pay your salary to sit there and, watch football on the weekends rather than working on your business. You are going to have to build that business with your own money. organically through building value. Value is what investors pay for, and not future value, but real present value. And so just because something is not an investable business doesn't mean it's not a great business. So continue to build that. I think that in most cases, we like to see about $300,000 worth of revenue, and companies looking for $100,000 to $150,000. Now, understand that in most cases, they're going to want 30 to 40% of the business, even at a discount, and so, the most that you're going to end up seeing coming your way is maybe 25% of the equity going to the investors, and you keep about 75, but don't give away too much equity too soon. One of the deals we reviewed recently had given away, they were just short of pre-revenue. They were just making their first revenue. First quarter revenue was looking to be about $100,000, and they had taken about $100,000 worth of investment to make it happen from outside investors. They had put about $100,000 of their own money in, but they had given away 40 to 50% of the company for the first $100,000. And boy, that's tough because even if I wanted to put in another 100,000 and take 20 to 25%, that means the founder only has 25%. And even if you cram down everybody else and dilute everybody equally, the investor's still going to have less than 50%. So I hate seeing that. I just don't think that that's a motivating factor for most entrepreneurs. I like to see investors keep 30, 35, 40, 45, even 50%. Long term, because I think it keeps the entrepreneur engaged in the business long term. There's no faster way to demotivate a founder than to deprive him of the equity downstream, and that's what we're trying to fight against, so that doesn't happen. So, anyway, we're going to be talking in another video about what should be in the pitch deck and how to organize a pitch deck, and what it should look like. I'll even show some examples, hey, look, it's important to understand what the parameters are and to be realistic. You're not gonna, if you have no revenue and no subscribers and a great idea, there are great ideas out there that are all the time. I see hundreds of them a month, and they're all great ideas. The problem is that it comes down to potential execution and the use of capital and things like that. Taking $100,000 and investing in a business that's going to make $100,000 in revenue for the first couple of years and return about $20,000. It would take 5 or 10 years just to make your $100,000 back. That's not a very good use of capital. It doesn't mean it doesn't make money, and it doesn't mean that you wouldn't eventually get your money back. It's just that most investors take a look at the risk-reward ratio and what the timeline is for that money to make more money. And I've been criticized before on Quora for people saying, well, you investors only want to invest in sure things. Well, yeah, if there's something that we know is going to be successful or something that we think is going to be more successful than something else, then yeah, we're going to invest in that because that is what we expect to produce a return. The statistics are horrible. Less than 1% of businesses survive that get funded, that get outside funding. And so, only 4% of the businesses seeking funding ever get funded. And so it's important that you understand that, if your business model is wrong, or you've got the wrong team, or you've got the wrong idea, or you already have competitors in your space, there's lots of reasons why your deal might not get funded. But you have to do the research, you have to know what the opportunities are, and you have to be well organized and present everything clearly. And for God's sake, if you send me something and I say, man, that's a terrible idea, or I think you're going to have trouble making that happen, don't argue with me for another 3 days, sending me email, every 2 hours, saying what a horrible mistake it is on my part to miss out on your opportunity. Prove me wrong. Go out and make $100 million and call me up on the phone from your private jet and go, hey, you missed out. I will be happy for you. I will be like, hey, good job. I am excited for you. Congratulations. You made that happen. And you didn't need me to do it. And that's what I want to see. I want to see 100 people in the next 10 years call me from their private jet going, ha, you missed out. Good. I'm glad I missed out. Because you know what? Because I missed out, you didn't. And that's what's important in the long run. Anyway, Gordon Miller from G3. Thanks a lot, guys. Follow me on Quora. Subscribe to the channel. More great videos coming. Thank you.